Well, welcome in, everyone. I've got a very special treat to you today. Mr. Jim Hunter has decided to spare some of his generous time with us to help us understand futures trading and the futures markets. He is always found in all of the right places, talking to the right people. He's a frequent guest with us. You may already recognize him in the gold and silver spaces. He's also been a prior guest at Palisades Radio, where he was a contributor there. Again, when this gentleman talks, please take time to listen. He knows his stuff and he's a straight shooter. And that's why I decided to bring him on to help us navigate this market in what I think is an opportunistic time, in particular with the precious metals. You'll see we have this nice backdrop of the gold and silver here, setting the stage for what I think is going to be a momentous occasion in the markets. Mr. Jim Hunter, let me stop talking. Get on in here. How you doing today, sir?
Thank you, Liberty, very, very much. It's a pleasure to be with you here on a Friday, and actually a decent day. We had an up close in both gold and silver, and it'll be fun having the meeting. Thank you for the invitation.
Yes, sir. My pleasure. So I'd like to get to know you a little bit better. Can you kind of tell us your genesis story and how you got yourself into being a futures broker?
Yeah, I was a little bit about my past. I was an independent business owner in my 20s, and first one was an airplane leasing company, and then the next one was a series of franchised candy stores. I ended up with 4 of those, and how I got into futures, I was, trading mutual funds a little bit, gold. I had a long-term position in a gold mutual fund. So I was, just by my makeup, I was interested in gold, and then silver. I was buying, I got silver dollars from my grandparents every Christmas, $1 silver a year, and kind of got me started a little bit on, 1964 and before, quarters, half dollars, Kennedy half dollars at that time. I received a postcard in the mail one time from a futures brokerage company I'm from the Twin Cities. It was from Minneapolis, and it was a managed fund postcard. And basically the gist of it was, if this managed fund performed well, you could invest at $10,000 and receive $1,000 a month in perpetuity. So I found out about that a little bit. I went and had a meeting with the broker in his office downtown. And shortly after that, that broker moved to be the co-manager of a futures company, a futures brokerage in San Francisco, in the Embarcadero area downtown on the waterfront there of San Francisco Bay. It stuck in my mind a little bit, and I ended up talking with one of the other brokers in that same office in Minneapolis, and started trading with him a little bit, and decided that I kind of found that I had a pretty good interest in buying and selling things. And that started before futures, but met with the manager there, and got a program, self-taught book, not self-taught, but online, not online,
Sure.
but at home correspondence course to get what's necessary for futures brokers is a Series 3 license rather than a Series 7 for stockbrokers. So I got licensed and started my career 1986 in downtown Minneapolis, and went to visit a friend of mine that stayed with me on occasion. He was an airline pilot for, at that time, Northwest Airlines. And he moved to Florida probably in about 1992, 1993. I went to visit him in January of 1995. It was 72 degrees. He took me to Clearwater Beach after my airplane arrived at the St. Pete Airport. It was 72 degrees there. I had my long pants on and my dress shoes, that I'd go to church in or go to the office in. And I went home and sold my house and moved to Florida in 1995. So I've been a broker, independent broker now since 1995. I affiliated with another, because of compliance reasons, with another brokerage, Allendale Incorporated, out of McHenry, Illinois. It's a Chicago suburb, and I've been there for about 5 years or so. And I'll be there throughout the rest of my career, as long as I decide to work. So I've been a broker since 1986. I work with customers that are both hedging customers, producers in agriculture, as well as speculator clients. And some of those clients are the same. They trade agricultural commodities to protect price, and might trade gold or silver or heating oil or something like that for speculative profits.
So, Jim, can you help break us down? I want to set a foundation for everyone so nobody gets priced out of the discussion. So let's start simple. What does it mean to be a futures broker, and what does an average day look like for Jim Hunter?
Well, a futures broker, I trade futures only or options on futures only. I do not have a license to trade bonds or stocks, mutual funds, anything like that. And that is by desire. I didn't really want that license. And the reason I wanted a futures license is because of the leverage. And we'll talk about leverage throughout the meeting today, Liberty. And the reason that I'm a futures broker is because of that leverage, the ability, the opportunity to take a small amount and control a larger total contract value of an underlying contract of a lot of different things. There's a lot of futures contracts that your audience might be interested to learn about. There's foreign currency contracts, there's US dollar index contracts, stock index contracts, treasury bonds, treasury notes, that kind of thing.
Right.
Our office that I grew up in, so to speak, from 1986 on until 1995 was very much a grain office. They were very interested in helping in the upper Midwest, agricultural farmers. Another broker in the office had one or two large soybean crushing facilities. So they would be interested in buying soybeans, converting those soybeans into soybean oil and soybean meal, and then merchandising those products out. So that's what I do by choice. I didn't want to be a stockbroker. I never thought about being a stockbroker. And the big difference is the leverage component that, once again, we'll get into, and with a couple of examples, total contract values, things like that. What it means for me is I start my day, first of all, since electronic trading, that kind of wiped out all the floor traders that were independent or salaried or salary plus commission independent contractors that work for maybe banks or big grain companies or big oil companies that would have a desk at different exchanges. And if people ever saw the movie Trading Places with Dan Aykroyd and Eddie Murphy and Jamie Lee Curtis, we can not forget about her.
Right.
That was a representative movie of an orange juice pit where the brokers would go in and they would buy and sell orange juice. And the gist of that movie was reacting to a government report on orange juice. And those days are gone. They've been gone for several years. Now it's all electronic trading. And the electronic trading for gold and silver, we'll be talking about those mostly silver today. But the hours of those, they start on Sundays at 6 o'clock Eastern, and they'll trade through the following Friday at 5 o'clock with an hour off each day from 5 o'clock p.m. Eastern to 6 o'clock when they'll restart again. So they're the metals markets and a few of the other markets, they trade 23 or 20 or 22 hours a day, something like that. Gold and silver trade, once again, they trade 23 hours a day starting Sunday, ending Friday at 5 o'clock. Today's Friday, 5 o'clock Eastern, they'll be done until Sunday night. So I get into my office and I look for things that are affecting price. I look at the price right away when I get in. And I start about 7 o'clock, 10 after 7 Eastern time. A lot of my customers are in the central time zone, so it's 6 o'clock for them. And I look at things that are affecting price. I have Fox Business on my television set in my office, and to find out what might be affecting markets. And a lot of things that affect markets, Liberty, are government reports or geopolitical events. Most recent one is in February. The Ukraine was invaded again by the former Soviet Union, Russia, and that can affect things. Weather can affect things. Weather is not going to affect gold and silver very much, but weather certainly can affect if things are dry, which they are in some areas of the United States. It can affect wheat production, corn production, or grasslands that cattle may graze on. So I look at those kind of things. I talk with clients during the day, find out if they're interested in maintaining the positions they have or adding or taking profit or minimizing losses, and go from there.
Very good. What do you think is the biggest misconception that people may have in association with futures trading? What do you hear a lot that people get wrong?
I spend a fair amount of time looking at what followers write and what other people write, people that I follow on Twitter. And I
Okay.
would say the biggest misconception that I believe that's out there, truthfully, is that people realize falsely, or they think falsely, their attitude is that futures are a rigged game. All right. I don't think people understand that futures, one futures contract has one buyer and one seller. Okay. I hear often read often on Twitter that futures is analogous to banking, where it's fractional reserve trading, which absolutely makes no sense at all. That fractional reserve banking is a way that banks make money, and they'll take their depositors' funds and be able to lend out 90% and 80% and then 60% to different people. Futures liberty is one buyer and one seller per contract, analogous to if you and your wife decided to buy a home, you employ, or you might find a realtor, you might find a home that you like, you go under contract with that home, and it's a contract for sale. Same as futures trading in this instance. Another analogy might be that you decide to buy a Ford pickup truck. So you go tomorrow to your Ford dealer and you find a Ford pickup truck that you like, whether it's electric or gasoline. You decide to buy it, you enter into a contract, and if they have it in stock, you may get delivery that day. If they have to order it and build it to your specifications, it might take 60 days or 45 days or something. Futures, it's not exactly the same as that, in that futures, you can either, if you're a buyer, you can take delivery if you choose, but it's not necessary. The futures contracts typically are traded where the majority is offset before a delivery period. And right now, the September contracts for gold and silver are in delivery, and probably those buyers and sellers, the majority of the deliveries already happened, but the majority of people that might be interested in the next month, which would be after September's October, okay, those people that are in the long October gold now or long October silver, they may decide to take delivery if they choose to, if they're long, or the short might decide to make delivery if they're short, but it's not necessary, okay? So it's not the people that write or that opine on Twitter or in other marketplaces that futures is rigged. Maybe I might say that there are instances where where I agree that there may have been some manipulation that has gone by. And if I can define that, it would be causing price movement in one direction, either down or up, and at that time benefiting from that movement that you caused. If that has happened, that's a pretty simple definition of manipulation.
Right.
I believe that has happened in the past, but recently in the news, one of the big banks had some floor traders that were being adjudicated, and I think 2 of the 3 were found guilty of some unlawful order entry. And but getting back to what you asked, I think the misconception is that futures is rigged. If futures are rigged, are they only rigged in silver? Well, that's what I spend a lot of time and reading different responses or listening to what people are saying. And is it only in silver? It's not in platinum, because platinum's $900, but it was $2,000. Palladium was $600, and now it's $2,000. So I would opine, my opinion would be that I don't think that there is rigging going on a daily basis. I don't think anybody's out for one class of trader. One class of trader might be a commercial trader. An institutional trader might be another class of trader, and a speculator might be another third class of trader. So I guess that we can leave it at that, but not rigged. I guess I'd like to dispel that on a daily basis. And certainly there's no fractional reserve. Not one person has got, not one short has got a contract on that same 5,000 ounces of silver with 8 people. They might have 8 contracts of shorts because they've got 40,000 ounces in their possession that they're long, but they are not selling the same contract over and over and over again.
So you said something that piqued my interest. You're mentioning these different classes of traders. So in the typical equities market, you kind of have the same thing. I mean, you have people who just like to trade options. You have people who like to buy and hold. Maybe they go buy Apple and not look at it for 20 years. And you have people who do swing trades. So let's compare and contrast that to futures trading and who it might be right for, the kind of personalities who would really do well, and kind of what's the difference?
Yeah, we'll start with the three classifications of traders, and then we'll kind of go to what I see as the advantages of using futures versus equities.
Okay.
All right. The first type of trader might be a producer that produces, let's say, copper. They mine copper, or they produce soybeans, or they drill and receive crude oil out of the ground. They produce crude oil. Right. So they're a producer. Their adverse movement of price would be against a producer's product would be in case the price fell down. So they might be a natural hedger client that may be interested in a short hedge, a substitute sell in the market, in the futures market, to protect them in case the price of the crude oil that they're drilling, for example, goes from $95 to $80. A $15 hit is a big hit if you're producing crude oil. All right. The second type of trader might be a user, an end user. And that might be somebody like, let's say that your Uncle Charlie and his brother owned a bus company, a school bus company, right? And if they were in a large urban area, they might have, let's say, 150 buses. Well, those buses run on either diesel or gasoline. We'll just use diesel fuel for this example. They have a natural tendency to buy diesel fuel. And an adverse price swing against Charlie and his brother's bus company would be the price of crude oil going higher, infecting or influencing diesel fuel to go higher. And if diesel went from, diesel, folks, used to be $2 a gallon. It's $1.30 or so over gasoline now. If gasoline is $3.50, diesel fuel is $4.80 a gallon.
Right. Yeah.
So Charlie's bus company might be a natural client to be protecting themselves against the price of heating oil going higher. So they would be a buyer, a substitute buyer of their diesel fuel in the futures market, or a long hedger. So we've got a short hedger in the first producer example, and then we've got a long hedger in the second commercial category, a long hedge or a buyer. The third category of trader that might be out there might be an investor or a speculator. That you can use those terms interchangeably if you want to. But under the speculator group category, there might be 2 or 3 different kinds, or depending on size or education or size of the account. Might be an individual, might be a hedge fund, it might be a certified trading advisor. It might be a pension fund that trades insurance pensions or teachers' pensions money, okay? And all 3 of those people, the funds, the hedgers, or the CTAs, and even John Q. Public or Mary Q. Public, they would be interested in trading futures. And the advantages that I guess that I'll list there's several. First of all, you trade it for the money. And to make a profit or to protect a profit or a margin. The producers and the users need to protect their margin or their profit. And using the bus company as an example, they can do okay. Their monthly bottom line is better if diesel fuel is $3 than if it's $4.50. Well, in the last 2 years, diesel fuel went from $2 to $4.70. And it's been higher. We have dropped. It was over $5 here a while back. All right, so the reason or the advantages of the futures are the money and the leverage. All right, so that bus company or Mary Q. Public, she can buy something or sell something. It's a two-way trade in futures. You can decide 2 different variables to decide when to enter a market. One is your selection of what you're going to decide to trade for a speculator. And then the timing. And the timing is that will decide if you're going to be a buyer or a seller. And a couple of things, a couple of different analyses in the futures industry help decide that timing. And one is a study of price action or charts, if you will, and that's called technical analysis. And then the other analysis are things that affect demand or supply. And one of those might be the recent invasion of the Ukraine by the former Soviet Union, the Russians. That affected a lot of things in the market, as well as energies and even gold and silver, gold more than silver, back in February. And another advantage for the futures is that for the bus company, for your uncle, is that he can buy and sell whatever his needs are. He can hedge if he decides to protect himself from the price of heating oil going up. One contract of heating oil is 42,000 gallons. He may use that 42,000 gallons a month. I'm not sure, however much however many buses he has, but he can tailor a hedge or his specific order, according to what his desires are. And he can use leverage to go in and do that. Leverage on a heating oil contract, let's say it's 6,000. Well, he can post a $6,000 margin deposit. We'll talk about margins here in a little bit as well. And then he can control, or he can protect himself from the price of heating oil going higher. He probably doesn't mind if the price goes lower. Although if the price does go lower, let's say he hedges at $4.50 a gallon basis, let's say the December heating oil contract. If the price goes lower, it's $420 a penny that he is going to lose in his futures account. At the same time, you would equate that 1 cent loss that his supplier is giving him a 1 cent lower price on the diesel fuel. It's called heating oil, but it's heating oil and diesel fuel are the same. He will basically cap or lock in his margin at that $4.50 in this example. He doesn't care if the price goes lower, but it's going to be deadly to him if we add $1 to the price of his diesel fuel per gallon. So that is, they can use the leverage and maybe cover one contract, 42,000 gallons for $6,000 of margin money. And the margin can go up or down depending on what the exchange, dictates. The exchange dictates margins increase during high volatile times. And volatility is just sharp movements, either up or down, or both up and down in very short periods of time. And if we move 7 cents, or let's say 10 cents in heating oil in, let's say in 2 days, well, 10 cents times $420 a penny is $4,200. You can see that a long hedger, if the price went down $4,200 in 4 days or 3 days or 2 days, he's likely to be on margin call. His $6,000 has whittled down to $1,800. And he gets a margin call from his broker. We'll talk, maybe about margin calls when we get to our examples a little bit. Okay, another big advantage is that we've got tight bid-ask spreads. Okay, so if somebody's going to be hedging a lot of crude oil or a lot of silver or a lot of gold or a big inventory of treasury bonds that they have, the treasury bond contract is $100,000 of US treasury bonds. It's $101,000 bonds is the coverage. That gold behind you, Liberty, that you're looking at there, you would have more.
I worked a lot of overtime for this, by the way, Jim.
Yeah, you would have a lot of contracts of 100 troy ounce contracts of gold to hedge that contract, all that gold behind you if you were interested in doing that. But it's available. Okay, so we have tight bid-ask spreads, and in silver, it's normal during the day to see a bid-ask spread of a half cent. And in gold, it's normal to see a bid-ask spread, meaning if the last trade was $1,900, the bid is $1,900 and the ask is $1,900.10, 1900.1. So we have very tight bid-ask spreads, so people can conduct business in a very liquid market and not get burned, trading 5 contracts, 8 contracts, or 1,000 contracts. 1,000 contracts might move the market a little bit if you put it in at one order, but if you have 3 or 4 250 contract orders, you'll probably get those done without much price movement. You don't want the price to move against you when you're entering large orders. All right. Another nice advantage, Liberty, of futures that might pertain to these 3 types of traders, the speculators I'm talking about, but the 3 types of speculators, the funds or the institutions or John or Mary public, is that they can trade either direction. Okay, if let's say that they are looking at, we'll have you put up a December silver chart a little bit later in this meeting. But let's say you're looking at a chart and John Q. Public says, boy, we're down pretty low. I've been looking at the chart and it looks like maybe in the last 3 weeks, last 3 trading weeks, we may have bottomed in the price of silver. Somebody watching the chart might come to that conclusion, and they might want to call their futures broker and say, I'd like to buy, okay? So they can instruct their broker to buy however many contracts that trader wants to buy. Let's say they want to buy 3. So they buy 3 contracts at $19, let's say $19.50, all right? So they buy that, okay? And if they have, if their timing and their analysis was correct, and the price goes to, let's pick a number, let's say it goes to $30, and that futures trader, that speculator might say, okay, I think that we've had enough movement. I think we're going to have a pullback. Well, in futures now, he can liquidate his longs, take a profit, but he can also instruct the broker to sell 1 contract if he thinks that he might want to take advantage of a short-term move lower. So futures will allow somebody to buy low and sell high, or sell high and buy low. And the trader gets to decide which they do first, which scenario, if they buy low and sell high, or if they want to sell it and then they can buy it back in the future, and they can profit either way. And the profit, we'll get into that in a couple of examples later in the meeting. But the profits can add up nicely because of the concept of leverage. And so you can have a 2-way trade. If you contrast that with somebody that has 5,000 ounces of physical silver, you can't really, I don't know of a way that if you're holding 5,000 ounces, I don't know of a way to protect that without a futures contract. If you think that the price of silver is going to, let's say it's had its move to $30 from 20, and that you want to pretend, or you want to protect yourself on that 5,000 ounces of cash silver, physical silver that you have, I don't know of another way to protect that outside of going short silver futures to protect yourself going lower. There might be an inverse silver fund that I'm not aware of. I don't, I'm not licensed to talk about funds. But basically, a big advantage of futures is you can decide what to trade, when to trade it, and which direction. You can have a potential to earn a profit both ways, upside and downside.
Right.
All right. Another, I think, big example or big advantage of futures is we get to tailor, like if we go back to that bus example that your uncle has, the fleet of buses. If he buys another company out, if business is really good for him, he's a good operator, he's been in it a long time, all his buses are paid for, and somebody in the next large city, let's say I'm from the Twin Cities, and those cities are Minneapolis and St. Paul, and let's say your uncle is the bus company, owns the bus company in Minneapolis. Well, if the bus company in St. Paul, if the owner passes away, he's 75 or something like that, and his heirs don't want to run the bus company because his heirs are professional people, your uncle might make a bid for the bus company in St. Paul because he's got a fleet of managers, he's good in business, and it would be, might be an ideal candidate to buy in another city, the bus company that's for sale due to death or change of interest or for whatever reason. All right, futures, your uncle's bus company is hedging his diesel fuel. Futures can easily accommodate if your Uncle Charlie's bus company grows or finds himself reducing in size. If he owned 3 different cities' bus companies, if he sells 2, we can tailor his orders to what his desires are. It's very easy to do that. So you might call it scale. We can trade scale up or down what the customer needs in terms of what to protect if he's a producer or a user, or if it's a speculator, if they inherited a big bunch of money and they want to trade twice as many contracts, it's easily done with a phone call or order entry on a computer. Okay, and then the other big advantage of futures versus maybe somebody might say, all right, I can trade a futures contract or I can trade an ETF on, let's say, on physical silver, okay? Futures, if the buyer or the seller of the futures contracts decides, they can either, the buyer might take delivery, the seller might make delivery. So the ability to receive or to offset, to give away physical metal, as long as it's, 1,000 ounce, 0.999%, COMEX worthy bars, but that's what they're trading when they're trading futures contracts. They're trading, 5 1,000 ounce bars of silver, or behind you, those aren't 100 ounce or 100 ounce bars of gold. Those are probably, 84 pounds or something like that.
Yeah.
I believe 100 ounces would probably be around 15 pounds, a 15-pound bar. But the futures trader can make or take delivery at their discretion, at the buyer's discretion or at the seller's discretion. And I will honestly say that there's one classification of hedger, okay? They're called bullion banks, where they've got contracts with the mines that mine gold, or they mine silver, or they mine platinum. They supply cash in return for the raw mined silver, dory bars, if you will, that the mines produce. And then that bullion bank might take those dory bars, they do take those dory bars to a refinery. And that refinery then makes those bars, takes the impurities out and casts them in, if you're talking silver, in 1,000 ounce bars for silver. And then the bank gets those bars from the refinery to their warehouse. And the bank then can enter into a short on the futures exchange, on the silver COMEX exchange. And they can sell one contract of silver, and that's 5 of those 1,000 ounce bars as a substitute sell. And then they decide to make delivery during the delivery period. The delivery period starts, like for December silver, it's going to start the last business day of November. And it runs about 28 days. So that it'll run until just after Christmas time for the December contract. But the bullion bank can actually deliver the metal, and that's the second part of their business model. Part one is they trade cash for the dory bars of silver, the raw silver. And part two is they take the refined silver and they trade it for cash to speculators or funds, or John Q. Public, or an institution, or a certified trading advisor. There's actually Liberty, you may have seen him. I'm not going to say his name, but there's a man on the on Twitter that he takes delivery of the bars and then he subdivides them. He's got a saw and he cuts them up and then he stamps them, he weighs them and stamps them, and he sells the bars. And you can buy a 30-ounce slice, or you can buy a 50-ounce slice, or something like that. And that's ingenuity at its finest. He's taking delivery and then cutting them and shipping them off for cash. And some investors are buying those bars. So those are nice advantages. Several advantages is why those 3 types of speculators and the 2 types of hedgers use futures. I guess for the money and leverage, using the leverage, and for the money either to protect either their profit margin or the adverse price movement, and then the speculators trying to ensure a profit or make a profit. And that's the type of traders that might use futures rather than equities.
All right. So there was a lot of info in there, and I had some follow-up questions that you ended up kind of answering about 70-80% of my question already, but I'd like to localize it for the viewer and put a timestamp on it. So when I go buy an equity, I have to decide why I'm interested in the first place. I might look at their management, their forecasts, their revenues, all these things, their resources. Let's say it's Exxon. Okay, and so I make all of these considerations and I decide that I like the equity. And then I have to look at the underlying and say, well, do I expect oil to go up or down? And so are there any kind of special considerations that are taken that might be different than the kind of research I do when you're investing in the futures? You already mentioned some geopolitical risk and all that, but maybe you could put some color on it as a compare and contrast.
I think the type of analysis or the information that you might want to process might be actually a little harder for equities, for companies. In futures business, Liberty, we really only care about price risk. And the price risk that you really want to care about is adverse price risk that will generate a loss for your trading. So there's types of analysis that are chart watching, price action. People call that technical analysis. And then fundamental analysis, something that might affect the price that in the future or in the near future, like a hurricane might affect the production of crude oil in the Gulf of Mexico, or a freeze that might affect the orange crop, or war if a country that produces something gets invaded by another country.
Sure.
Former Soviet Union, something like that. So really, we only need to research and be concerned about price risk, not something other that a corporation might have to worry about from their executive team, chief financial officer, chief executive officer, something like that. So I would say that it's a little easier to analyze futures than equities or funds.
Okay. And also, I'd like to just make clear, if a pension were to come to you and say, Mr. Hunter, we want to invest, you would help them find the best option to suit their needs, right? You'd help navigate, or?
Yeah, a pension fund has a team, to be clear and to be honest about it. They have a team that's well versed in asset allocation and dividing up the 100% of their funds or assets under management. And there's a very famous man that has now retired from the Sprott Company, and his opinion seems to be that these big institutions may only have an asset under management allocation of maybe 0.5% of their assets that are allocated to the precious metal space.
Yeah.
His opinion, I don't want to speak for him, but his opinion seems to be, or might be, if I can paraphrase, that when they get back to maybe 0.5% to 1% assets under management allocation to precious metals, they have so much money under management that might be a very good, bid or buy or floor underneath the market at these prices. So in answer to your question, they would come to me maybe to facilitate the trade, but Liberty, they probably already know which direction and what asset they select the commodity that they want to trade, and they know which direction they're going to want to go, and they also know what size they're going to want to trade. They're not going to take much direction from a broker when you're a pension fund. They know what they're doing. They're professional folks.
Okay, so throughout this whole thing so far, you've been mentioning leverage and margin balances. So let's go ahead and get into that. So what do we need to understand about these two things?
Okay, let's talk about leverage. All right, gold, a 100-ounce contract of gold at $1,700 has a total contract value of $170,000. Okay, and that's basically a 100-ounce bar times $1,700 a bar is $170,000. Silver, we'll talk about silver, and then our examples will be talking about silver. Silver, let's say it closed at $19.50 today. It's close to that, but let's say $19.50. The total contract value for that contract of silver, that 5,000-ounce contract times $19.50 is $97,500 of total contract value. Okay, where the leverage comes in is through the margin deposit that is required by the exchange.
Okay.
And the margin requirement is the underlying basic fact or feature why futures work. The exchange, in this case, the COMEX exchange, requires $8,250 from the buyer of the futures contract and $8,250 margin from the futures contract. So each side has a margin deposit through their futures brokerage of $8,250. They may have more than that, but they may have $100,000. They may have 4 contracts long or whatever, but per contract, it's $8,250. All right, so we're controlling 5,000 ounces of silver. Basically, we're long, let's use that example, we're long $97,500 of contract value, total contract value for under 10,000. Okay, so that's the leverage factor. All right, that's the beauty of futures, is that you put up a little bit, a good faith margin deposit, and the rationale and the reason behind the margin deposit is it's what makes the futures contract work. And the margin can be changed, the amount, the 92.50 or 82.50, it can be 11,000. In my career, I've seen it be 3,000 on the downside, $3,000 to hold a contract.
Yeah.
And it gets adjusted either up or down in terms when we have short periods of big movement, call it volatility. So if silver moves $2 or $3 an ounce one way, let's say it goes up $2 or $3 an ounce, It did in February of 2020 during that Silversqueeze movement. And then shortly after that, a day or two later, it went down $3. So it went from 27, it went to 30, and then went down to $27 again. So a $3 up, $3 move down, $6 move in a week, and 3 up, 3 down. Okay, both sides had margin calls during that. All right,
Yeah.
and why the margin is so important, Liberty, is that that's how the winning side gets paid. Futures, by definition, okay, leverage derivative contract, they settle at the end of every day. On silver, they settle at 1:25 in the afternoon. Then there's an after hours market that goes until 5 o'clock Eastern. But at 1:25, that's the settlement of the day. Let's say that you're long one contract, and let's say that silver finished up 10 cents. Okay, your futures trading account will show tomorrow morning, Saturday morning, it will be up $500 for every contract that you're long silver. 10 cents times 5,000 ounces equals $500. It's $50 a dollar, or $50 per penny of movement. All right. The person that you bought the contract from, his margin gets decreased by $500 for each contract. So let's say that Smith sold you the contract. You don't know who it is. It's just an account. You don't know what company is on the other side of the trade. It really doesn't matter. But his brokerage, the seller brokerage and the buyer's brokerage, ensures that you have $8,250 of margin on deposit in case the market goes against you. If the market goes against you, if you're long, your margin gets decreased, and the person that's short, his margin, his futures account gets increased. Happens at the end of every day. So that's another beauty of futures, is that you don't have to wait to get paid. It's instantaneous. It will be in your account in the morning. You could have that $500 sent out if you wanted to via check and still hold the silver. In stocks, if you're trading a fund or an ETF of silver stocks, if you have a margin account, you can get that money sent out, $500 if you want to. But if you don't have a margin account, you have to sell shares in order to, generate liquid money. So that's the beauty of futures, is that open trade equity, you can use it to buy another futures contract, or to be sent out if you want to pay rent, or buy a motorcycle, or buy gas or groceries, or go on a vacation for the weekend.
Right. So let's get into that risk aspect of this a little bit more. I know that I can trade options, and I understand that they can come to expire. They could be worth zero. It is my understanding you can lose a bit more than zero in futures. So can we talk about that and how that works?
Sure. Let's say that you open an account for $10,000 and trading, let's say, a contract of gold. And the contract of gold, the margin is $7,200. All right. And gold had, I'll be honest, gold had a rough week. It made a new low for the move yesterday, and it made a new low for the move today. So let's say that you had a contract of gold on earlier in the week. And let's just say you had it on, for ease of discussion, let's say you had it on at $1,900. Okay. For every contract of gold, every $1 is $100, because it's a 100-ounce bar. That's the contract. And for every dollar of price movement up or down, it's $100. So if you're long and gold falls by $50, okay, $50 times 100 per dollar is $5,000. All right. So your account, if at the beginning of the week you bought it at 1,900, and at the end of the week it's 1,850, okay, your account has your short margin right now. So you dropped $5,000 from your 7,250. You're at 2,250 of margin deposit, but you're on margin call for 5,000. You got to get that back to 7,250. Okay, if you left town for the weekend and you're not back until Tuesday, and gold opens and trades lower Monday, your account could go underwater, under zero of value. Meaning your margin went from $2,250 on Friday's close. That's how much money you've got in your account. If we dropped another, let's say $30, which is $3,000 on Monday, at the end of Monday's trade, now you're deficit a few dollars. Let's say you're deficit $500. Okay, so you get a call from me on Tuesday, because if I'm your broker, you informed your broker you're going to be out of the market, you're going to be out of town, out of the country, if you will, or someplace not able to be reached. I send you a text on Monday, say you're on margin call before Monday's trading starts, before you get going. You're on margin call for 5,000, but the market drops again Monday. You're deficit now Tuesday morning when you get in, when you get back to your office. Okay, your deficit, you get an immediate call to wire in the money to get you back from deficit, from minus, let's say $500 back to plus 7,250. So plus 7,250 plus the 500 you were negative underwater, you need to send in about $8,000 and it needs to be wired in right. Okay. If you say, Jim, something happened while I was out of town, we had an emergency or something, I can't meet the margin call. Okay. I'd say, all right, then if you cannot meet the margin call, let's get out of your futures trade. So we're long gold. We're gonna enter an order to sell one contract of gold, and you're out now. And let's say your deficit after your your fees and everything. Let's say your deficit is $600 or $550. You'll be asked to send in that $550 to get your account back to zero. And then when you've got money in the future, you can deposit money in the future for margin again to trade gold or silver or corn or whatever you want. So there is risk, and you brought up a good point. In futures, if you have an open trade on, you have a position trade, and the market goes against you, you can lose more than you have on deposit. Okay, so if you have versus a stock account, if you bought the stock, if you bought 100 shares of something at $10, you've got $1,000 of stock that you bought. You can't lose more than that stock that you bought. Okay. Because you paid for it in a non-margined account. You didn't buy it on margin. You paid for it up front. But that's one of the drawbacks of futures. But it's because that there was adverse price movement, and we could have had a stop loss to protect that. You could have seen it going against you. You could have had a cell phone, so you were aware of it on Friday afternoon's trade, and we could have got you out Sunday night when they opened at 6 o'clock. So there are various things that we can do to protect equity. Stop losses, certainly one of the main orders that a person can put in to protect equity.
So let's turn it around and talk about reward. How might this work in the inverse, and how might you set up? I'll tell you what, after everything we've talked about to this point, let's put up a couple of examples, if you would, of how you might position, because I think gold and silver are in a really good spot. And if they're not here already, we're getting there soon. So
yeah, can I maybe ask you, do you have a December silver trade chart there that you can put up for us?
Yes, sir, I do.
Okay, and just for ease of discussion, we're just going to let's use $19.50, okay, as the closing price today.
All right.
On Friday at 1:25 p.m. today. All right, let's use an example, and maybe let's make up an example that you've got a brother, Liberty, that got lucky a year ago when he sold. Let's say that 3 years ago, he bought some Bitcoin, and he bought 1,000 Bitcoin at $50 per Bitcoin. And the market started heading up, and he got real lucky, and he sold out of his 1,000 Bitcoin at $50,000 per Bitcoin. That's 1,000 Bitcoin times $50,000 per Bitcoin. That's a $50 million trade. Okay, gross. That's his receipts minus the 50,000 that he paid. But let's say he's got $50 million. He owes some tax. So let's say that your brother netted $35 million after tax. Okay. All right. I'm here to tell you that, Liberty, that your brother is a great prime candidate to trade futures if he wants to. He knows how to buy low. He knows how to sell high. He's got adequate net worth in the millions of dollars. And he might come to me and he might say, Liberty introduces his brother to me, and he says, I want to have a futures account. I want to trade silver. I might counsel him to say, okay, your net worth, on your paperwork says how many, that you're worth huge buku money. And let's open your futures account, let's say for $50,000. And if you like trading futures, you can add to it in the future if you want to. That might be a way to do it. So we buy one contract of December silver at $19.50. Okay, we'll use that example. And we lock in at $19.50. And let's maybe use a couple of different scenarios that maybe he wants to make $2. Okay, Well, $2 in silver with the leverage involved. If he makes $2, I already mentioned that each dollar in silver, it's a 5,000 ounce contract, is $5,000 profit. So we buy it at 1950, and he instructs me, your brother instructs me, to put an open order to sell it from 1950 to 2050 to 2150. So for your brother's account, I enter an open sell order to sell one contract of December silver at $20.50, giving him a $2 profit times each 5,000 ounces. It's going to be a $10,000 profit. He more than doubles his money. His margin was 82.50. So he makes 10 grand. Let's say that trade clears on, let's say November 1st, a month and a half away. It clears he makes $10,000, pays his fees, and he nets $9,980, something like that. His fees were, let's say his fees were 100. They're not that much, but let's say that his fees were $100. All right. Let's say now he says, all right, Jim, he says, I like that. He says, let's do that again, but I want to do that in the March contract because December doesn't have a lot of time left. A speculator can be long until first notice day, and first notice day on that December contract is November 28th, 29th, whatever that last business day is. So he says, all right, Jim, would you think that it'd be okay to trade March? I said, of course, Liberty's brother, it's okay to trade the March contract. So now we're going to enter an order to buy a contract of March silver. And let's say that he buys it at 20.50, the current price, where the December is. He'd end up paying a few cents more. But now he wants to make $5, okay? And it's my opinion that silver, if we had a $2 up move in a month, we might be able to have $5 up, in the next month or 2 or 3. And he's buying March silver in November. He can trade it until the end of February. So we enter an order to buy one contract of March silver at $21.50. And we enter a sell order $5 higher. $5 higher from $21.50 is $26.50. And lo and behold, that open order gets filled on, let's say it gets filled on Valentine's Day. If Valentine's Day is a trading day, he clears his trade, and now he just netted $5. Well, $5 times $5,000 per dollar equals $25,000. Liberty, it's 300% return, a little over 300% return. And so that's how leverage can really work. If you contrast that by somebody that bought 5,000 physical ounces of silver, okay, he had to pay he wouldn't have bought it at $19.50 to start with.
Right.
If he would have bought a coin, let's say a sovereign coin, maybe American Eagle or a Toronto or a Canadian Maple Leaf, he may have paid $29 or $30. Well, he would have had to come up with 5,000 times 30 equals $150,000 of cash to make that same $5,000 or $10,000 profit on the first trade, and the $25,000 profit to have it go up $5,000 on the physical silver. And they will track, the COMEX price will follow through to the spot price that the coins are based off of. So if are you there still, Liberty?
Yeah.
Okay, I've got a zoom. Let me see if I need to reduce that. If the futures price goes up $5, the spot price is going to go up $5. The spot follows the futures. So that's the beauty of futures and the beauty of leverage, that you can put down a smaller amount, in this case, maybe 5% down, and benefit 100% of the move. It's a great attribute of the leveraged industry.
So let me ask you this. How much time can I buy in futures?
Well, there's a trade that I like to do that we could use another example coming up that might be a covered call option, if some of your future listeners and viewers are familiar with that. And that's where you buy a stock and sell a call against it to generate a little bit of income, or you buy the futures and sell the call to generate a little bit of income. And personally, I like to stick about 90 days or less, 90 days or 60 days or less, because I don't want something to happen when silver is this discount. If folks will remember your silver chart, we're way down from where we were a year and a half ago. Silver traded $30 and change. We're under $20 right now. So I don't want somebody to get locked in to, if they're long futures and short a call against that futures, I don't want that person, my client, getting locked in for 6 months. I don't mind if it's 60 days, 70 days, 45 days, something like that, because then we can take advantage of the next option cycle. Right now, the current option cycle might be December futures. Well, December futures and options on December futures, they're going to expire. The December futures expire in the delivery period, but the options expire in November, about 3 or 5 days ahead of first notice day for the futures contract. So if you were in a December futures contract now and short December call, you might be getting out of that call about the 26th or 25th of November. That's just fine with me, because if silver's $22 at that time, we can go into the March futures then and sell another 90 days, approximately 90 days on a March call, but we might be selling the $25 or $26 call at that time.
So you think it's better to roll them around instead of trying to go out too far in the future?
What it does, Liberty, is it gives you a chance to make 2 profits. That's the beauty of a covered call. You can make a profit on the futures contract and then a profit on the call that you sold, the premium that you received for selling the call. You can make 4 or 5 cycles of option premium and 4 or 5 times 2 profits per trade, the futures plus the option that you sold, in the versus selling a buying a December 2023 futures contract at this time. And if you bought a December futures of 2020, you're going to pay a few cents more for it than you are for the December 2022, because they have to factor in the insurance carry costs and the interest rate for that futures. So the December 2023 contract won't be the same price as the December 2022 contract. I would like my client, if you're my client, I would like you to get more comfortable with doing shorter term trades, just because in case something really clicks with the silver and the gold market, and gold starts trading over 2,500 and silver over 25, 26, $28, we'll be able to sell higher strike price calls for the same or more money, because of the volatility is increasing in the silver market. Right now, volatility is fairly low and option premiums are relatively low compared to what they will be when silver is $28 or $30.
Okay.
So you can buy as much time as you want, but I would counsel my client, if you were my client, to maybe temper that a little bit, with the intent that we've got option cycles to make 2 profits per trade, potential 2 profits per trade, at least 1 profit per trade. When you're long the futures and you're short the call, you're guaranteed, I hate to use that word, but it's correct. You are guaranteed, as long as that call is covered by that futures contract, to make the money that you sold, that premium, to the speculator that bought the call from you. The risk in this case is in the futures contract, not in the call. If you naked sell the call, either in the securities business or the futures business, you can subject yourself to unlimited risk upside, because if you sold a $22 call and silver's trading at $23, $26, $28, $30 during the life of that call, that call's open, you're getting margin calls every dollar up. So I'm not a real good seller. I'm not an advocate of selling naked options, unless I will mention to you, my favorite trade in the world is selling a put at the low of a futures market that I determine is at its lows. And that might be, let's say crude oil trades down to $50 or so. Never say never that it can't go lower than 50. It did, a year or two, it went negative, but that's a different story for another time. But I don't think with the setup we have now, with the energy dependence we have worldwide, the energy demand, I think crude oil is probably pretty safe between $50 and $60. That there isn't much downside from there. Personal opinion.
Yeah.
All right.
And so this kind of reminds me of, I've heard you talk about this in the spaces before, where you have mentioned, no, don't take delivery, leave it there so that you can essentially utilize it, right? And this is basically the reason why, right? Because you can cover it.
Yeah. The methodology for taking delivery, it would be my opinion that my clients don't need to take delivery unless they need the silver. If I've got a dentist or a jeweler, a dentist might need to take delivery of gold to fill teeth. I don't think they use gold fillings anymore, but or a solar panel company. If they were a client of mine and they needed silver, then let them take delivery. But for a speculator client, the upside of taking delivery is really negative in that, I think I've demonstrated that, for those 1,000-ounce bars, in order to take delivery, you have to have 5,000 times $20, let's say. You have to have $100,000 of money to delivery of the physical metal, when you can cover that same 5,000 ounces by using the margin deposit, the leverage margin deposit of 8250. Well, if you've got the $100,000 and you're going to put it in silver, and you think we're at the lows, I might suggest that maybe let's buy 3 contracts of silver.
Yeah.
Okay.
Yeah,
Instead
sense.
of buying 5,000, instead of buying 1 contract and taking delivery, let's use $25,000 of your margin money, 3 times 8250. Let's say it's 25,000, and we'll have 15,000 ounces of silver. Well, if silver goes from 20 to 30, in the first scenario where you took delivery, you made $10 on 5,000 ounces. That's a pretty nice trade, but it's 1/3 as nice a trade as making $10 on 15,000 ounces. $150,000 profit versus 50. So I don't think that my client needs to take delivery, but if you've got all that gold behind you, Liberty, if you're a multi-millionaire and you say, Jim, I want to start stacking silver, we can enter an order in your futures account and we can fully fund your futures account in the delivery period, the day before delivery, actually. So first notice day comes and your account is fully funded, because you may get delivered on the first notice day. The short decides, the short who's long the physical decides when the delivery date happens to the corresponding long, his counterparty long. And then he trades the money, the long trades his money for the short's physical silver. So it's a swap. First day, it's T+2. T means the trade date plus 2 days. The first day of the 2, the futures settles out. And the second day, the short transfers his physical silver via a warrant or via title to the silver to the long. In this case, you'd be the long. And Liberty's cash money transfers from his brokerage account to the bullion bank's brokerage account. And that gets done by the back office. And on T+2, the trade is done. You no longer own the futures anymore on T+1. On T+2, you no longer own the cash, you own the silver. And you could get a pallet, a rack behind you and start putting silver bars on it if you wanted to.
So we keep talking about silver being in the gutter. What are your expectations? Do you have any? Does this time remind you of anything at all in your 36 years?
I think that, the natural order that comes to mind is a couple of brothers out of Texas in 1980. And then again in 2011, coincidentally, we end up at the same price. And that price was a very realistic $50 an ounce in 1980, and then again in 2011.
Yeah.
Well, since then, let's say if we just take the move from 2000 to 2011, the gold market from the 2000s, it went from about $250 to, let's say it went to $20, I'm sorry, to $2,000. The recent high in gold is $2,079 in probably March of this year. All right, well, from 200 to 2000 is 10 times your money. Okay, silver went from the year 2000 to 2011 and then to now. It went from, let's say, $8 and it went to $50, and then it started sliding. And we've come all the way back down to, a recent low on silver, probably 40 days ago, probably 30 days, calendar days, not that many trading days. We put a low in on silver. I think I've got the low here of $17.86, the first day of September. All right. Well, $17.86, let's call it $18. $18 is a fraction of the high that has been made twice. So it would be my opinion. Do you have the ability, Liberty, to put up maybe a 5-year chart of silver? We can look at that. All right, let's take a look at that with your viewers. And it would be my opinion, I guess my personal forecast, that silver, maybe we could stretch that to 5 years or 10 years if you've got that. that silver, once it gets going, the chart seems to clear up nicely, getting over $26 on the silver currently. And as we get through $26, then the next levels are going to be $30 to $33. And if we can take out $30 to $33 on silver, the chart cleans up nicely, and then it kind of opens up to maybe a return run at those highs that were made twice before in history. Well, if we're $19, let's call it $20. If we're $19, $20 on silver right now, and we go to $30, that's a nice move. That's a $10 move, basically a 50% move from 20 to 30. Well, in futures, I already mentioned earlier that futures, due to the current margin requirement, it doubles every $2 up. That's a pretty nice return. That's 5 times your money,
Yes, sir.
5x on a move from 20 to 30. Well, I think we just get going. My personal forecast for silver would be to make a run to $30 to $33, and then let's see how it trades at that time. And if we can get north of $33, I think it opens it up again to, I'm not one to talk about triple digit silver, although that number has been, bantered around on Twitter a little bit by different people. But I guess a realistic target for me is $26 in the future. And then after that, maybe to $33. And let's see how the market trades at that time. Still a nice return on investment, if you're a futures trader.
Sure. So Jim, you had mentioned earlier, and the reason why I want to bring this up is because you hear about it all the time. And what I appreciate about you is that you're a straight shooter. And you hear about the silver squeeze. You had mentioned it earlier. And if you look around the Twitter sphere, there's a lot of information out there, and it continues to pop up about commercials going long. You've got a lot of interest in the SLV. There are massive positions being taken. There are massive short positions being taken. There's a lot of interest circulating silver right now. I mean, there is a lot of interest. It feels like something is brewing here. But let's distinguish what's what. Okay, so let me give you a hypothetical. If all of the participants who participated in that silver squeeze would have focused on a singular vehicle to move the silver price, whatever it might have been, whether it was futures or a PSLV or anything, physical, whatever, if they were all concentrated, could they have done more? Could it have been sustained, or was it all destined to come to the same place?
I think, Liberty, for your hypothetical to get that much, let's call it what it is, collusion, that many people to band together and put their dollars, their purchasing power behind themselves with a group that large, okay? The silver squeeze movement did a great thing by exposing the price of silver that was mid to, late mid 20s, $26, $27. They certainly, hypothetically, your question is, could they have done better? Well, first of all, I don't think that the silver squeeze people are big proponents of futures, but let's be honest here with my presentation or with this meeting today, I think I've demonstrated how the maximum move in futures is what, spot silver is going to follow. So if we're just, throwing a dart at the wall and saying, let's move the silver price. All right. First of all, it's illegal for, I don't know how many people, I think they've got well over 100,000 followers, that Wall Street silver squeeze movement. So let's just comfortably say 100,000 people colluded, pooled, let's not use colluded, a negative derogatory term, pooled their funds together under one CTA, certified trading advisor. They got all their account paperwork done, everything else. And they said, we're going to move the silver market. All right. If they came to Jim would say that's illegal, but I'm going to say, if there's a way to do it, the way to do it is to buy silver futures and start taking delivery. Okay. All of a sudden now, every day for several days or for maybe several months, people are going to be buying futures contracts and taking delivery. There's a few people on Twitter that watch the deliverable stocks, the registered stocks in the COMEX warehouses and the eligible stocks. The eligible stocks can become registered stocks for delivery, but that would have been decent visibility, if that's the right term, to the world that there was let's not call it a whale, let's call it a buying frenzy. Okay, a whale connotates one person, or one family buying something to move the price. But an ethical answer would be that it is collusion, and they caused this price movement and they benefited from it. And due to my spiel earlier in the meeting today, Liberty, you understand that that's textbook manipulation. Okay, so
Right.
if I was their broker, I wouldn't take their order. It's a tough order to turn down.
Yeah.
I think they did the best thing they could.
Yeah.
In that what they did was they exposed in February of 2020, they exposed a whole new group of people, of buyers.
Yes.
And not every one of those buyers was 67 or 70 years old.
Right.
Maybe a big bunch of those buyers was 20 or 25 or 28 years old or 30 years
Right.
old.
Yeah.
And they might be buying silver now. They'll get very interested and excited ×2, in my opinion, when silver starts taking out that higher level that I mentioned here 5 minutes ago of $32, $33, $34. We start taking that out and people are going to start buying more. There's going to be a much more interest in silver than there is at silver at $19. I'm kind of the opposite. I'm kind of a value player that I want to buy cheap. And looking at your chart that you put up for us all, for all the viewers, silver's cheap. Silver,
Yeah.
my humble opinion, I'll call it my informed opinion, is that silver is a good value under $25 and under $20 an ounce with what we know today, the industrial offtake, and coincidentally, the new investment uptake demand that's coming on. Silver's a gift under $20 an ounce.
I agree. Absolutely. We talked about, you like fundamental analysis. There's a lot of news going around about the physical market. What do you think about the physical market? Do you think that there's a genuine shortage here? What's your take on the state of physical?
No, I'm not licensed, nor do I have any interest, nor do I have any close contact in the physical market that might be, you might use that analogy to somebody that has a retail or online coin store that sells bars, silver eagles, things like that. In terms of the futures side, okay, I've got an informed opinion there. I do not think that we are at a shortage of the 1,000-ounce bars at this particular point. Okay. There's, I believe, when I last looked earlier in the week, there's approximately 322 million ounces in COMEX-approved warehouses. The majority of that is in eligible category, meaning it is not currently listed as with a warrant attached that can be used for delivery, but it can be, and I think it will be, some of that silver for people that took delivery at $25, $24, $23. To be honest, Liberty, the longs have been losing since March of this year. Every month that's gone by, they're underwater, all right, with the bars that they took delivery of. But that ceases to be a problem at $30, $32, $33 silver. We haven't been $30 silver since a year ago, February, all right? I think that some of those bars in eligible category might become registered category, because somebody might say, I'm throwing in the towel. I was underwater $5 and I made $2. I got, I turned a $5 loss into a $2 profit. On each contract, it's 10 grand. I made 10 grand and I'm out. I'm going to redeliver, I'm going to retender my silver. I'm going to instruct my broker to enter a short order. And let's say it's in the March 2023 contract and they want out and they put an order in at $30 and they're tired. Okay. They may be tired. That one trader might be tired because he wrote it down from 25 to 20. All right. But there's a lot more people that just got awakened from this Wall Street silver group that says, okay, I've been buying all the way down. I've been buying at, basis the futures price, not the cash price for American Eagles or Canadian Maple Leafs. I've been buying all this time, basis 20, and at $30 silver futures price, my American Eagles are worth $42, and they bought them, let's say, at 30. All right, they're ahead $12. Are they selling? Well, they might not be selling if they're 28 years old, Liberty. They might be buying more. I don't know if they're, doubling down and buying twice as much, but I think that the Wall Street silver squeeze movement did their viewers, their audience, their members a big favor by identifying something, in my opinion, okay, and we can get to this, as we're closing up, but my opinion, silver has nowhere to go but up. And I kind of view things, my honest opinion is I view things in terms of risk versus reward. I'm on record beginning of last week, it's almost 2 weeks ago now on Twitter, saying, I think that we've got about $1 downside in silver, and I would say $5 to $6 upside. And then I would review it again at that $25, $26 from 19 currently. And but my opinion would be after we hit 25, 26, that we're on our way to take out that $30 that we hit in. It was like $30.30. That was the intraday high of that current. Probably it was the May contract because it happened. It might have been the March contract because it happened in February of 2020.
It is interesting, Jim, that you sent me over some charts. Maybe we can take a look at them, but they're the seasonality of the metals. And if you've ever listened to my technical videos, I'm a big fan of confluence. And it is really interesting to me that we're kind of coming down right now as the metals traditionally. Well, let's just take a look at the charts. How about that?
I think that this meeting with you is coincidentally timely, if we can say that.
I think it's going to age very well, Jim.
If you want to give us the seasonal gold chart first, Liberty, that'd be great. And then we'll look at silver second, if you've got that ability.
Yep. So
there's silver first. We can look at silver first. Okay. All right. If your viewers can look along the bottom of the axis, it's the calendar. And each month is denoted by about a 3/4 inch column. And we're just a day after the exact midpoint of September. The midpoint was the 15th, because there's 30 days in this month. And it's pretty easy to extrapolate from this chart that the mid part of September seasonally might be an okay time in the years past, okay, to expect that we're near some kind of seasonal low. All right, now seasonality, it's a little bit different than soybeans. All right, for soybeans, the seasonality, the big one is harvest time. And then you might be thinking about the July or the August contract when you're running low before the next harvest starts. Silver doesn't really have a harvest seasonal because the mines are drilling or digging for silver all the time, 12 months out of the year, unless they're in, if you watch that movie or that TV show Gold Rush on television, they have to shut down in the wintertime. But some of these things are in South America. There might be a production seasonality, but this is just the futures. You'll see it, the silver futures seasonality. And by coincidence, I'm sharing this meeting together with you, that it looks to me like it's a great time to start. If a new person out there, a new viewer out there is interested in looking at going along, I think it's a great time to be looking at futures.
So, Jim, as we kind of wrap this up, I'd like to ask you a couple of more questions. So what can you pass on to someone who may be listening to this? Maybe they are 20 years old. I mean, you talked about a lot of people who might be suited for this trade and who might not be. What do you have to say to anyone who might be 20 years old out there and listening to Jim Hunter said, I want to be that guy? Do you got any advice for that kid?
Yeah, let me quickly review, Liberty, the suitability for a potential client that is interested. Doesn't have to be my client. I'm not here to solicit business, but if somebody wants more information, they can certainly contact me by direct message on my Twitter handle. But let's just talk about suitability. In order to open a futures account, okay, you've got to have sufficient income, decent net worth. And then we're going to talk about risk, the ability to take on risk. You might call it risk tolerance. You got to be interested in personally in your gut, in your makeup to take on risk, because futures are inherently risky. If they move against you, they can move against you. Like I mentioned, gold made new lows for the move yesterday and today, closed a little higher. So, but it's not speaking well for gold unless gold starts really performing. Silver did not make a new low. The low was made September 1st. All right. In answer to your question, okay, that covers suitability a little bit. Suitable to be a broker, I might offer a couple of hints, and that would be for that 20-year-old young woman or that 20-year-old young man, they must have some sort of mentor or uncle or somebody in their life that has done well or that has planted a seed in their heart or in their gumption quotient
Sure.
to find out about leverage, find out about futures, or find out about stocks or bonds or something like that. The bottom line is, in our business, it's can you or do you, and do you have desire to have your money work hard for you? Okay.
Mhm.
If somebody wants to be a futures broker, they've got to understand that their potential client is somebody that desires to have their money work hard for them rather than somebody that might be an annuity buyer. Now, it might be the same client might be an annuity buyer and have a futures account, but I would expect that their annuity balance might be, multiples higher of their $10,000 futures account or $20,000 futures account, something like that. So they can have buckets. A successful family or a successful professional woman, attorney or actress or whatever their job is, doctor, they can have buckets of funds in different things. But I would like that broker, that hypothetical person that's interested in being a broker, I would like them to pick the brain of whoever got them interested in the first place, because futures is not something that rolls off the tongue of the general public. A mutual fund might, or Apple. That 20-year-old woman or 20-year-old man probably has an Apple phone or an Android phone.
Mhm.
Okay, so if they have an Android phone, they might know that it comes from Google. If they have an Apple phone, they might know it comes from Apple. So they might be well suited to be looking at the corporate makeup and the profits of Apple or Google or some other company, electronic high-tech NASDAQ firm. But if they are interested in futures along the lines of what your setup is, that I would encourage them to try and find an internship with that person, with that uncle or that neighbor or somebody, that banker or that hedge fund man that lives in a successful part of the neighborhood, or he might be a relative or something, and see if they could maybe offer, probably they didn't have a philosophy degree, probably they had an economics degree, or they've got a B school, a business school master's or some MBA, if you will. Probably they may have got exposed to leverage there, and futures, certainly, like we talked about in the silver, you put 5% down, you control $97,000 of product. That's exciting. That's exciting to the people that are, viewing this. And it gets more exciting when I say, you double every $2 at the current margin, and I'm looking for silver to trade $30, in the next year or two. That's, that's a 50% return on the underlying from $20 to $30, made five times your margin money at $8,000. That is the rationale and the reason to have interest, to maybe explore it, but to figure out if helping people, listening to phone calls, you got to be able to take complaints, you got to be able to understand. They'll learn about all the margins. They'll learn about all the different months. They'll learn about how big a futures contract is in soybeans or in copper or in orange juice, if they're going to trade orange juice. I don't trade orange juice, but that can be taught easily. But I think that what I would encourage that 20-year-old is to find out if they love the thought of helping people, number one, and number two, they love the thought of leverage. They might be an ideal candidate to be a futures broker. All right. There used to be desks that had floor traders, okay, and they had runners and they had managers and they had, office staff. And it was easier in the 1990s, okay, for somebody to have an in. It's harder now. Right now, those desks are staffed with bankers, professional bankers, Bank of America, JP Morgan, Deutsche Bank, things like that. So that 20-year-old prospect to be a broker, they may ask to do an internship with the leverage side of that managed money at that bank. There might be a hedge fund component to that bank. There might be a certified trading advisor, a CTA component. That's a commercial broker, futures broker that trades customer or fund money. Or there might be a pension fund desk at that bank that handles pension funds. And that 20-year-old might take the next 2 years or 3 years getting their MBA and then kind of circulating amongst those different departments and find out where they like it. And what might be a key component where they like it is how the manager or how the chief executive of each of those desks treats that intern, treats that 20-year-old young lady or that 20-year-old young man. And they might be able to find out what their where their desires lie. It might end up being in insurance. It might end up being in pension management. It might end up being a private wealth banker for wealthy people, something like that. So that's the encouragement that I would give, is for them to pick the brain of the person that introduced them and find out if there may be an opportunity for either a paid or an unpaid internship or an entry-level position, and then to circulate amongst that professional bank. It will help if they're in Chicago or New York or San Francisco or Miami or something like that, a large city. It's going to be expensive for their rent to be there. Otherwise, they're going to have to commute in on a bus or a train or something like that. But I will mention that, I've been a broker since 1986, and I'm glad I'm a futures broker, not a stockbroker. That's where my desire was. I like the leverage. I like the liquidity. And those would be my parting words, is to pick the brain, find out where you can get exposure, and go in kind of like a sponge and try and absorb as much information from as many different departments of that professional financial services company. Could be an insurance company, could be a bank, could be a payments company, something like that. And ask questions and be open to, being able to decide or temper your desires, in case you like pension funds or you like insurance rather than futures.
Jim, throughout your experience, a lot of wisdom sometimes comes from pain. So could you give us maybe one example of a hard lesson learned that you never repeated that might help us? A little nugget of wisdom there.
The big thing in my business is letting a loss run too long. Okay. So the easiest is, let's say that put on a trade, and let's just say you're trading one contract. We've been talking about silver all day or during this meeting. Let's say we're going to trade gold, one contract of gold. Okay. And I might offer that it's better to trade something you don't have an emotional attachment to. Okay. You have a lot of pallets of gold behind you, Liberty. You're attached to gold. I would say that you might love gold. Okay?
There's a lot of overtime, man.
All right. So I might encourage you your first futures trade to trade a contract of soybeans. Okay.
Okay.
Something you don't have any interest in, you don't care about, so you're not attached to it. And if you're behind 30 cents on a contract of soybeans, it's $1,500. It's not going to be too hard to get you out. Okay. So if I could impart a little bit of wisdom, it would be, and it's well known in the financial services industry, you let your profits run and you cut your losers. All right. So that would be, it's not an original notion that I'm repeating here. It's not mine. It's just you asked, and I'm trying to answer truthfully and confidently that it's okay to have 3 losses in a row if they were at $900 a piece. If your winner's going to be, you made $10 in silver and the margin was, you doubled your money every $2. You made a 5x return. You can afford a loss or two.
That's a great answer. I think that was a really good answer. And you see that a lot out in public. People really do get attached to an equity or a notion or an idea, and they can't let it go even as it collapses. And so that is, I think, great advice. You see that a lot.
Let's just go back to March, April of this year. We had silver coming down from $27. Well, it dropped from 27 to 17, let's call it $10. That's an expensive move. That's $50,000 move on a one contract, trade.
Yeah.
That's not good for anybody. Now, your brother that made the 50 million, he might say, all right, I'm going to buy more every $2 down. That's not Jim's way of doing it. Jim's way of doing it. My other rule that I would tell your listeners, and there's another gentleman that I'm aware of that he advocates the same thing, another silver guru, if you will. I like the idea. I learned in my career, let's add to a winner. Okay. So if we were at $27 or we're at $19, we didn't add to that trade, Liberty. we're going to add to that $27 trade at $29 or at $30, something like that. So Jim likes to add to winners for Jim and his clients.
One more kind of fun question before I let you go, Jim. You talked about trading places a few times. So what was that like? What would that have been like? How the heck did they make sense of anything when they're on that floor and they announce their trade, right? And then the whole room stirs, they come running with the slips, and then they announce the crop report and they do it all over again, and they're just handing slips. I mean, how in the world did anybody make sense of that nonsense?
The premise of the trade was the Dukes brothers, the owners of the firm, were going to hijack the government report, okay? And what Eddie Murphy and Dan Aykroyd did was they intercepted the government report and replaced it with a false report.
Right.
So they had the correct report in their hands, and they knew that the Dukes were going to react to the report, and they show it on the movie that at a certain time in the morning, let's say it was 10 a.m. in the morning, the report was released. Well, the Dukes started reacting to what the report said, the falsified report that Eddie Murphy and Dan Aykroyd inserted into the envelope, okay? And very comical, if you remember that the employee was in the gorilla suit and there was a real gorilla in it. It's comical. People can look it up on YouTube, or they can maybe find it, on something to watch the movie if they've never seen it. Trading Places, Eddie Murphy, Dan Aykroyd. All right, in answer to your question, they used the floor traders had no floor traders had their own sign language, okay? And if I may, I'm not going to get it right, but okay, yeah. Hands out was they were selling, hands in, palms in mean they were buying, okay? So this means I'm buying, this means I'm selling, okay? Well, the crux of the movie was Dan Aykroyd and Eddie Murphy, they partnered up, so both of them were inside the pit. They knew what the true report was, so they knew what it was going to be announced at 10 o'clock, the false report, okay? So they started, I don't remember if they were selling first. I believe they were selling first at, let's say, 9:30 in the morning. And then at 10 o'clock, when the false report was released, the Dukes, who had been buying all the trades that Eddie Murphy and Dan Aykroyd were selling to them before 10 o'clock, that gets reversed. Right. Okay. And so they waited for a little bit. If you remember, Dan Aykroyd and Eddie Murphy, they waited for a little bit after 10 o'clock and they said, okay, buy them. So then they started buying up all the contracts. And at the end of that one trading day, the Dukes ended up broke, and Eddie Murphy and Dan Aykroyd, if you remember, I don't remember which was which, but one was on an island that they owned, supposedly drinking champagne or martinis. And the other one, I believe it was Eddie Murphy, maybe, was out on the yacht. They had really turned their fortunes to the good by intercepting a government report. That is, again, illegal, unethical manipulation, but it was a movie. It was, and it's fun to watch.
Yeah, it is.
And just to offer, Jamie Lee Curtis is always fun to look at from back.
Yeah, well, things sure have come a long way. Just all the chaos of swapping hands with those slips and all the just how crazy it was. They did such a good job capturing that and what those floors might have looked like sometimes. So it's fun to see, interesting. But Jim, any parting words, any closing thoughts you might have?
Yeah, if I could just, I guess my parting word is a big thanks to you, Liberty, for inviting me on. I think it's seasonally on the seasonal chart. It's a good time, mid-September here to maybe generate some interest in people that are watching. They don't have to do it with futures. They can buy more silver if they want to, if they think it's going to go up. Once again, that's a calendar seasonality chart. So that will be replaced with seasonal weakness after Jan 1. If you remember that chart, you can search for that seasonal silver chart on any search engine on the web and you can come up with one. Silver, I want to, our futures, I want to just kind of go over that it involves risk of loss. More than you put in, you can end up losing if you're stubborn, if you're not able to communicate with your brokerage. I would encourage a novice to use a well-qualified, well-seasoned commodity broker rather than an online broker. Don't be penny wise and dollar foolish. You're using an online broker because you like $30 fees rather than $75 or $80 fees. $80 when you're talking about total contract value of $97 or $130,000. The fees aren't that much, and a well-informed broker can help you, get over rookie mistakes quickly. And it honestly is, to all your listeners, it's been an ongoing business for me for, I think it's 36 years now. There were futures before me. There will be futures after me. It's a great business. There's great opportunities. You can trade either way. If you think things are going lower, you can sell. You think things are going higher, you can buy. So you can buy low and sell high, and you can do either one first. You can sell it first or buy it first. And it's great fun. It really is.
Well, Jim, it was a real pleasure to have you come in and share your expertise. I will say that if anybody wants to talk to Jim, his Twitter name's right there. Feel free to reach out to him. He's a regular participant with us again every Saturday night, 7 Central, in our gold and silver spaces. He always takes questions. He's always happy to answer them. He's a really good resource for us. He's been very helpful imparting his knowledge on us and sharing with us what he sees and what he knows. And so by all means, come join us. You're welcome to participate and speak with Jim directly if you'd like to. Otherwise, Jim, it was a real pleasure to have you. And thank you again for sharing your time with us.
Thank you, Liberty, very much for the opportunity, the timely opportunity, mid-September. Thank you.
Yes, sir. We'll do it again. We'll follow up.
Granted. Thank you.